This is Mirror Business FM. Next on Morning Drive, we're going to take a closer look at unfolding developments in the global energy markets amid the reported disruptions in the Straits of Hormuz, one of the world's most important oil and gas transit routes. Just over a fifth of global crude, something like 20 million barrels a day, I think, and liquefied gas shipments flow through this narrow channel. Recent events have put renewed pressure on supply chains and price forecasts, of course. Joining us once again, Karan Gupta is a global oil and gas expert. His experience spans market analytics, industry trends, and more. And hopefully, Karan, we can consider what this means for producers, consumers, and global energy flows. It's good to have you back on.
Thanks, Tim. Thanks for having me. Happy to be here.
Sorry to be a little bit late coming to you. It's one of those days. Look, oil prices up this morning. What immediate effects are energy markets pricing in right now? I mean, so far, at least, given the reported disruptions around the Straits of Hormuz and the suspension of some shipments.
Yeah, so we've had the benefit of seeing one day of trading on Monday following disruptions over the weekend. Crude oil rose 13% in yesterday's trade, with Brent trading above $80 a barrel, $82 a barrel. And so, that's since the last time we saw disruptions or anticipated disruption of Jan 2025, that's already been priced in. The difference this time is that satellite imagery shows disruption in traffic flow, which didn't happen last time. So there is definitely a disruption now compared to last time, and the markets have priced that in already. And I do believe that we'll continue to see upward pricing pressure, at least in the short term.
How do oil and LNG, liquefied natural gas traders, interpret the recent warnings to vessel and advice to avoid certain Gulf routes? Is it mostly risk premium, or is it actual supply tightening?
So, we've already seen several international oil companies and traders stop shipments through the strait. So this is risk aversion. Supply exists. For example, yesterday afternoon, Maersk, which is a major shipping company, suspended all future transit through the strait until further notice. And also insurance companies have raised their premiums, leaving transporters the choice between not having insurance at all or paying very high risk premiums. So I think it's fair to say that the recent warnings have had an effect, and you can see that the transit route through the strait has all but ceased, and there's very few oil tanker traffic that's currently going through.
I've no wish to ask you for a prediction, Karan, at a time like this, but in terms of oil price forecasts, an opinion at least is interesting. Well, what levels are you seeing analysts considering if this strategic waterway remains constrained for an extended period?
Well, I think there's widespread talk of sort of the $100 Brent crude mark. I think that's sort of the consensus amongst most analysts. But, let's unpack that a little further. As you said, the strait accounts for up to a quarter of daily crude flow and at least 20% of LNG flow. So all of the flow coming out of Qatar comes through the strait. So for every day that marine transit is blocked through the strait, you're going to have 20 million barrels of oil per day that's off the market, as well as approximately 200,000 tons of LNG. Thus, there's a real possibility of this $100 mark being breached and sustained over the longer period of time, as we've seen in the past.
From a logistical standpoint, how resilient are alternative supply routes and also infrastructure to offset, potential choke point issues in the Straits of Hormuz?
So yeah, in terms of pipelines, Gulf countries really have two options. There's the East-West pipeline in Saudi Arabia, as well as the Habshan Fujairah pipeline in the UAE. So the East-West pipeline bypasses the Red Sea, and then the Habshan Fujairah pipeline bypasses the strait by going directly to the Gulf of Oman. However, both of these routes cannot make up for the 20 million barrels per day, maybe a quarter of that. So while they're resilient routes for Saudi and UAE, they're not a permanent solution to the complete disruption flow. And in terms of waterways, there's really only the one alternative, which is Bab el Mandab, which is the strait, the strategic strait between Yemen at the bottom of the Arabian Peninsula and Djibouti in Africa. So this is currently, already used as a shipping lane for oil between Asia and the Mediterranean, and Saudi can use the East-West pipeline to use the Red Sea through the strait to export crude, albeit in lower volumes.
You mentioned Brent crude earlier on. One of the global benchmarks, I think $82 a barrel was the price you mentioned. But how are global benchmarks like that responding in the near term? And what factors could push them higher or lower?
Yeah, absolutely. So, there's been a 13% spike initially. And what happens with oil and gas prices going forward really depends on a few factors. One is time, right? How long are we going to be stuck in a situation now where the Strait of Hormuz is blocked or partially blocked?
Yep.
That will obviously choke supply and push prices higher. The second major thing is energy infrastructure. So far, it's only the Strait of Hormuz that's blocked, but pipelines, ports, terminals, refineries are all operating as normal as of today. But any disruption here or potential disruption here could push prices higher, of course. And then, geopolitical escalation and de-escalation, right? Obviously, there's a risk of increased escalation, and that would have a direct effect on oil prices. Having said all of that, there is a silver lining, as we saw in Jan of 2025. There was immediate de-escalation following negotiations. So if that were to happen, prices could also go back down.
What indicators are you watching that would signal the market moving from a risk premium phase into actual supply disruption pricing?
So energy infrastructure, as mentioned, and trade flows. So, energy infrastructure staying intact is key, as we just talked about.
Yeah.
But the other thing, apart from traffic through the strait, would be the level of exports from key producing nations and the imports from, key importers. So seeing any material changes month on month, quarter on quarter, year on year would indicate changes in the market.
How about in terms of spare capacity, Karan? I mean, from this region, Saudi Arabia and the UAE hold an estimated, 2.5 million barrels a day combined, but that's a buffer that would only stabilize the market if shipping lanes remain, unaffected.
Yeah, absolutely. So, OPEC yesterday, they met yesterday as part of a regular meeting.
Yeah.
And they agreed to increase production by 206,000 barrels, I think it was, across all the producing nations, with a lot of that increase coming from Saudi and Russia as of April, right?
Yes.
So there could be further increases in the future from certain members, such as Saudi, to try and offset current disruptions. But there's a limit to how much that can increase, and producers like UAE and Saudi can increase all they want, but there's a limit to how much physical oil can flow out of this region, right? As we discussed. So the alternative pipelines exist, but they can't take the entire capacity. But OPEC is already trying to offset this disruption with the increase yesterday, and we may see smaller increases in the future as well.
Final question for you. For corporate and industrial energy consumers, what should CFOs and procurement teams be monitoring in the coming days and weeks?
So a higher oil price definitely has knock-on effects across the supply chain. It's not just higher transportation costs due to fuel prices, but there's higher insurance premiums, and there could be higher costs for downstream products, such as polymers, if the disruption persists. So in terms of, what our consumers can do, what CFOs and supply chain teams can do, they can revisit contracts to understand force majeure terms. They can obviously look for alternative supply. They would have to start budgeting in higher transportation costs to protect downside. And they could temporarily stock up inventory if able. And so these are some of the avenues that they can explore in the near term.
Karan Gupta, it's always a pleasure to talk to you. I do appreciate you coming on. Karan's a global oil and gas expert. Thank you for joining us this morning, Karan.
Thank you. Pleasure as always.
I appreciate you joining us.